Imagine waking up and seeing gold near 46.16 while silver is pushing towards $70. Then you look at the US debt clock and see a number above $40 trillion. This is not just another precious metals rally. The market is sending a message about debt, about the dollar, about interest rates, and about confidence in the financial system. The biggest question now is not whether gold and silver can move higher. The real question is what happens if investors start treating the $40 trillion debt level as a permanent threat instead of a temporary headline. That is where this story gets very interesting. Gold has been moving sharply higher in August. Recent trading pushed spot gold above $4,600 and near the $4,600 level mentioned in today's title. On August 24th, gold reached more than $4,649 in spot trading, according to Reuters. That was the highest level since May. Gold futures also moved above $4,700. Silver has also been extremely strong. Recent market data placed silver near $69 per ounce, with the metal pressing against the $70 area. That means the market is watching a major psychological level right now. And then there is the debt story. The U.S. national debt has crossed $40 trillion. That number matters because it changes the conversation. Debt is no longer just a distant Washington statistic. It affects Treasury yields, it affects interest costs, it affects the dollar, and it can affect how investors think about gold and silver. The most important part is this. A $40 trillion debt load does not automatically mean gold must rise. It does not mean silver must explode. Markets do not work that simply. But a massive debt burden can create conditions that become very supportive for precious metals when investors begin to question how that debt will be managed. That is exactly what the market appears to be watching right now. The first thing to understand is why gold has moved so quickly. Gold does not pay interest. A treasury bill does, a government bond does. A savings account can pay interest. So when real yields are attractive and confidence in government debt is strong, gold can struggle. But when yields fall and the dollar weakens, the equation changes. Gold becomes more attractive. That is one of the key reasons behind the latest move. Reuters reported that gold was supported by a weaker US dollar and expectations around upcoming inflation data. The market is also focused on comments from Federal Reserve Chair Kevin Warsh at Jackson Hole. This creates an important chain reaction. Lower yields can reduce the opportunity cost of holding gold. A weaker dollar can make gold cheaper for buyers using other currencies. That can increase demand. Then rising demand can push prices higher. Higher prices can attract momentum traders. Momentum can create more buying. And that can produce the kind of fast move we have seen recently. But there is another part of this story that may be even more important: the Treasury market. The U.S. Treasury recently announced a larger bond buyback plan. The market interpreted the move as support for the long end of the government bond market. Long-term yields moved lower after the announcement. That helped gold. It also raised a much bigger question about the relationship between fiscal policy and financial markets. Think about what this means. The United States needs to finance a huge amount of debt. Investors need to buy Treasury securities. But if long-term borrowing costs become too high, the cost of servicing that debt can become increasingly painful. That creates pressure. The government wants stable funding costs. Investors want compensation for inflation risk. The Federal Reserve wants to control inflation. The Treasury wants functioning bond markets. And the dollar needs to maintain confidence around the world. These goals can sometimes pull in different directions. That is why gold is getting attention. Gold is outside the liability structure of the U.S. government. It does not depend on a government promise to pay. It is not someone else's debt. It is a physical asset that has been used as money and as a store of value for thousands of years. That does not make gold perfect. Gold can fall sharply. Gold can have long periods of weakness. Gold can react negatively when yields rise. Gold can also experience huge corrections even during a long-term bull market. But when investors become worried about currencies or government debt, gold can become increasingly attractive. And now we need to talk about silver. Silver is different. Silver is both a monetary metal and an industrial metal. That makes silver more complicated than gold. Gold is heavily driven by investment demand, central bank demand, real yields, the dollar, inflation expectations, geopolitical risk, and financial confidence. Silver has those same forces. But silver also has industrial demand. Silver is used in electronics, solar technology, electrical applications, medical technology, and many other industrial areas. That means silver can benefit from a stronger economy in ways that gold does not. But it also means silver can be more volatile. When investors become bullish on precious metals, silver can move much faster than gold. That is why the move towards $70 matters. Silver does not need to simply follow gold. It can outperform gold when monetary demand and industrial demand arrive at the same time. And that may be what investors are beginning to price. There is another number that traders watch closely: the gold to silver ratio. When the ratio falls, it means silver is gaining strength relative to gold. When the ratio rises, it means gold is outperforming silver. If gold is near $4,600 and silver is near $70, the ratio is around the mid-60s. That is a very different environment from periods when silver trades far below its historical relationship with gold. The important point is not that the ratio must return to some specific historical number. The important point is that the ratio can tell us how aggressively investors are rotating towards silver. If silver continues to outperform gold, then the ratio can fall further. That could attract even more attention from traders. Now let us return to the $40 trillion debt level. This is where many investors may make a mistake. They may assume that more debt automatically means higher gold. That is not always true. Debt matters because of how markets expect the debt to be handled. Imagine two countries with the same debt level. One country has strong economic growth, low inflation, deep financial markets, stable institutions, and strong demand for its currency. The other country has weak growth, persistent inflation, rising borrowing costs, and falling confidence. The same amount of debt would not have the same market impact. So the key question is not simply how much debt exists. The key question is what investors believe the future path will look like. Will deficit shrink? Will spending fall? Will economic growth increase? Will inflation remain under control? Will Treasury yields stay manageable? Will the dollar remain strong? Will foreign investors continue buying U.S. debt? These questions are more important than the headline number by itself, and right now the market is asking them. Recent reports have described renewed stress in the Treasury market. Long-term yields have remained elevated even after the buyback announcement. That shows that the market does not believe one policy move can solve the deeper fiscal problem. That is important for gold, because gold is increasingly being viewed not only as an inflation hedge, but also as a hedge against fiscal uncertainty. There is a subtle difference. Inflation risk is about the purchasing power of money. Fiscal risk is about the sustainability of government finances. Currency risk is about the value of the dollar. Gold can respond to all three. Silver can respond to all three as well. But silver adds industrial demand to the equation. Now we need to discuss the Federal Reserve. This is where the next major move could come from. The Fed does not directly set the price of gold or silver, but Fed policy influences the entire financial system. When rates are high, the dollar can gain support. Treasury yields can rise, financial conditions can tighten, gold can face pressure. When rates move lower, the dollar can weaken, yields can decline, liquidity can improve, gold can become more attractive. But there is a major complication right now. Inflation has not completely disappeared. That creates a difficult situation for policymakers. If inflation remains too high, the Fed may want to keep policy restrictive. If economic growth slows, the Fed may want to ease policy. If Treasury markets become unstable, policymakers may face another layer of pressure. This is why investors often describe the Fed as being trapped. It is not literally trapped. The Fed has tools, but every tool can create a new problem. Cut rates too quickly and inflation expectations could rise. Keep rates too high for too long and economic activity could weaken. Allow long-term yields to remain elevated and government financing becomes more expensive. Support financial conditions too aggressively and markets may interpret that as a signal that policymakers are prioritizing stability over inflation. That uncertainty can be bullish for gold, and it can be even more powerful for silver if investors start searching for higher beta exposure to precious metals. There is also the dollar. The dollar is one of the most important variables for gold. When the dollar weakens, gold often receives support. That is exactly what has been happening recently. Reuters reported that a weaker dollar helped lift gold as investors prepared for new U.S. inflation data and the Federal Reserve Chair's upcoming remarks. This is important because dollar weakness can become self-reinforcing. Suppose international investors see the dollar weakening. They may decide to increase exposure to hard assets. Gold rises. That attracts more attention. More investors buy gold. The dollar may remain under pressure. Then silver begins to outperform. That creates a second wave of attention. This is how a macroeconomic theme can become a market trend. But we should not assume the trend moves upward every day. Gold can easily experience a sharp pullback. Silver can experience an even larger pullback. A move towards $70 does not guarantee that silver will stay above $70. A move toward $4,700 does not guarantee that gold will never revisit lower levels. Markets move in waves. That is why support and resistance matter. For gold, the $4,500 area has become psychologically important after the recent breakout. MarketWatch reported that gold broke above $4,500 as Treasury market moves pushed bond yields lower. It also noted that a close above the 200-day moving average near $4,510 could reinforce the bullish technical picture. If gold can hold above that region, then traders may begin watching the recent highs. If gold falls back below it, then the breakout could lose momentum. Silver has a similar situation around $70. A clean move above $70 could attract momentum buyers. A failure near $70 could create profit-taking. That does not necessarily mean the long-term trend is over. It simply means the market may need time to absorb the latest gains. And this is where investors need to separate a trading move from a structural trend. A structural trend can last for months or years. A trading move can last for hours or days. The debt story is structural. The Treasury buyback story is tactical. The Fed story is cyclical. The dollar story can change quickly. The industrial demand story for silver can develop over years. Understanding the difference is critical. Now consider central bank buying. Central banks have become an important part of the gold market. When official institutions add gold to their reserves, they create a source of demand that is very different from short-term speculative buying. A trader can sell tomorrow. A central bank may hold gold for decades. That gives the market a long-term demand foundation. It also reflects a broader issue. Countries want reserve assets. For decades, the US dollar has been the dominant reserve currency. That role remains enormous. But diversification can happen without a complete collapse of the dollar. A central bank does not need to abandon the dollar to buy gold. It can simply add gold alongside other reserve assets. That matters because it creates persistent demand. Silver does not have the same central bank demand story, but silver has something gold does not have to the same degree: industrial demand. This means silver can potentially benefit from two different engines at once. Investment demand can rise because investors want precious metals. Industrial demand can rise because the global economy needs more silver. That combination can produce powerful price moves, but it can also produce powerful corrections. Silver is a smaller market than gold. That means relatively modest shifts in capital can create large percentage moves. This is one reason silver often feels more explosive. Now think about what happens if gold remains above $4,500 and silver remains around $70. Investors may start asking where the next major resistance levels are. Some will look at historical ratios, some will look at inflation-adjusted prices, some will look at mining supply, others will look at industrial demand, and some will focus entirely on monetary policy. That creates a wide range of possible price targets. But there is one thing every investor should remember. A price target is not a guarantee. Markets can move far beyond expectations. They can also reverse when everyone becomes too confident. That is why the most useful question is not how high can gold go. The better question is what conditions would cause gold to keep rising. Right now, those conditions include a weaker dollar, lower real yields, persistent fiscal concerns, strong central bank demand, geopolitical uncertainty, and expectations for easier monetary policy. For silver, the list can include all of those factors plus strong industrial demand. If those conditions remain in place, then the current rally could have more room. If the dollar suddenly strengthens, then precious metals could face pressure. If Treasury yields rise sharply, then gold could struggle. If inflation accelerates and the Fed becomes more hawkish, then the market could reprice interest rates. If economic growth collapses, then silver could face industrial demand concerns. This is why the next few economic reports matter. Investors are watching U.S. inflation data, they are watching labor market data, they are watching Treasury yields, they are watching the dollar, they are watching Fed communication, and they are watching whether the Treasury market stabilizes. Reuters reported that traders were focused on the upcoming personal consumption expenditures inflation report and the Fed chair's remarks at Jackson Hole. These events could create significant volatility. A softer inflation report could strengthen expectations for easier policy. That could support gold and silver. A hotter inflation report could create the opposite reaction. The dollar could strengthen. Yields could rise. Precious metals could pull back, but there is another possibility. The market could interpret stronger inflation as a reason to buy gold because inflation protection becomes more important. That is why market reactions are not always simple. The same economic report can create different outcomes depending on what investors already expected. This is the part many new investors miss. Markets do not trade the news. Markets trade the difference between expectations and reality. If everyone expects weak inflation and the number is weak, then the reaction may be small. If everyone expects weak inflation and the number is hot, then the reaction can be dramatic. That is why gold and silver can move so quickly around economic data. Now let's look at the bigger picture. Gold has already shown that this market can change direction rapidly. Earlier in the year, gold reached a record near $5,598 before falling sharply toward the $3,900 area by the end of June. Since then, the metal has recovered strongly. That tells us something important. Bull markets are not straight lines. Even powerful trends can experience deep corrections. The recent recovery is impressive, but investors should not confuse momentum with certainty. Silver has the same issue. The metal can rise rapidly, but it can also fall rapidly. That is why position sizing matters, risk management matters, and patience matters. If you already own physical gold or silver, the objective should not be to panic every time prices move. If you are considering entering the market, you should understand the risks before chasing a vertical move. The fact that gold is near $4,600 or that silver is near $70 does not automatically mean the next move must be higher. It means the market has entered a major decision zone. The next decision will depend on the dollar, it will depend on yields, it will depend on inflation, it will depend on the Fed, it will depend on the Treasury, and it will depend on whether investors continue to believe that the U.S. fiscal situation can remain stable. The $40 trillion debt number is therefore not the end of the story. It may be the beginning of a new conversation. The question is whether markets begin to demand a larger premium for holding long-term government debt. If they do, then policymakers may face increasing pressure. If long-term yields rise too far, then financing costs increase. If policymakers respond with measures that push yields lower, then some investors may interpret those actions as financial repression, and that can increase interest in gold. This is the paradox. The more policymakers try to stabilize the bond market, the more some investors may want assets that sit outside the bond market. Gold fits that role. Silver can benefit as well. This is why today's rally deserves attention. Not because gold has reached a magical number, not because silver has reached a guaranteed destination, but because several major market forces are moving at the same time. Debt is rising. Treasury markets are under pressure. The dollar has weakened. Gold is recovering. Silver is approaching a major psychological level. The Fed is facing a difficult policy environment, and investors are looking for protection. That combination can create powerful moves. So what happens next? The most bullish scenario is simple. Gold holds above the $4,500 region. Silver breaks decisively above $70. The dollar remains weak. Treasury yields remain contained. Inflation does not force the Fed into a more aggressive stance. Central bank demand remains strong, and geopolitical uncertainty stays elevated. Under that scenario, precious metals could continue climbing. The bearish scenario is also clear. The dollar strengthens. Treasury yields rise. Inflation remains sticky. The Fed becomes more hawkish. Gold falls back below major technical support. Silver fails at $70. Momentum traders take profits. That could produce a sharp correction. There is also a third scenario. The market moves sideways. Gold holds its gains. Silver consolidates. Investors wait for more economic data. That would not necessarily be bearish. Sometimes a market needs time to build a base before making another major move. The biggest mistake would be assuming that every day must bring another record. Strong markets often pause, they breathe, they test support, they shake out weak hands, then they decide where to go next. So if you are watching gold and silver right now, keep your eyes on the relationship between the dollar and Treasury yields. Watch the Fed, watch inflation, watch the Treasury market, and watch silver around $70, because that level could tell us a lot about market psychology. If silver breaks higher and stays there, then the market may be signaling that investors are willing to pay a much higher price for both monetary protection and industrial exposure. If silver repeatedly fails near $70, then the market may need more time. Either way, the next phase could be extremely important. Gold at 4,600 in Cezanne is not just another price quote. Silver near $70 is not just another milestone, and 40 trillion in US debt is not just another headline. Together, these numbers describe a financial environment where investors are thinking much more carefully about money, about debt, about purchasing power, about interest rates, and about what happens when government borrowing becomes so large that the cost of maintaining the system becomes a major market variable. That is why precious metals are getting so much attention. Gold is once again being treated as a financial insurance asset. Silver is being treated as both a monetary metal and a strategic industrial commodity. The next move will not be decided by one headline. It will be decided by the interaction of the dollar, Treasury yields, inflation, Federal Reserve policy, government debt, central bank demand, industrial demand, and investor psychology. That is the real story behind the gold and silver rally. If you own gold or silver, then this is a market worth watching closely. If you are thinking about buying, then remember that strong momentum can create both opportunity and risk. Do not assume that a rising market can never fall. Do not assume that a correction means the entire trend is finished. Focus on the larger picture. The financial system is changing. Debt levels are changing. Policy expectations are changing.